On a quiet Friday in late 2023, a terrifying financial threshold was crossed, and almost nobody on Wall Street talked about it. For the first time in American history, the United States government spent more money paying interest on its national debt than it spent on its entire military budget. That is $1 trillion a year just to service the debt, towering over the $850 billion defense budget. It breaks down to $2.7 billion every single day just paying the interest. No new roads, no new hospitals, just the cost of carrying a $36 trillion balance on the national credit card. Federal Reserve Chairman Jerome Powell has been trying to fight inflation by keeping the Fed funds rate around 5.25%. But here is the brutal mathematical death spiral. When the Fed keeps rates high, the Treasury has to issue new debt at those high rates just to pay off the old debt. It is a fiscal Ouroboros. If Powell keeps rates high, he bankrupts the U.S. government. If he cuts rates to zero, he unleashes hyperinflation on the U.S. dollar. Today, we are going to look at the Federal Reserve's balance sheet to prove mathematically why they have completely lost control. How did we get to $36 trillion? Let's rewind to September 15th, 2008. Lehman Brothers goes bankrupt with $619 billion in debt, the largest bankruptcy in U.S. history. To save the system, Fed Chair Ben Bernanke initiated Quantitative Easing, or QE1. They printed $600 billion out of thin air to buy toxic mortgage-backed securities. It was supposed to be a one-time emergency measure, but Wall Street got addicted. By 2014, the Fed's balance sheet had swelled from $900 billion to $4.5 trillion. Then came 2020 and the COVID lockdowns. In response to a 34% drop in the S&P 500, the Fed didn't just step in, they went nuclear. Between March 2020 and the end of 2021, the U.S. created 40% of all the dollars that had ever existed in the history of the Republic. M2 money supply rocketed from $15.3 trillion to over $21 trillion. Congress matched it, passing the $2.2 trillion CARES Act, followed by trillions more. Debt to GDP, which was around 60% in 2000, exploded past 123%. The trap was set. Let's break down exactly how this machine works. The government doesn't just print cash. When Treasury Secretary Janet Yellen needs money, the Treasury issues sovereign bonds, effectively an IOU. Historically, foreign nations like China and Japan, or domestic pension funds, bought these bonds. But what happens when the U.S. issues $3 trillion in new debt in a single year? And foreign buyers say, no thanks. This is where the Fed steps in. The Federal Reserve buys the Treasury bonds using money they create with a few keystrokes on a computer. This is called monetizing the debt. Remember the quantity theory of money. M times V equals P times Y. If you increase M, the money supply, massively while Y, real economic output, stays relatively flat, P, prices, must go up. This is exactly why U.S. inflation hit a 40-year high of 8.0% in 2022. It wasn't just supply chain glitches. It was a fundamental dilution of the currency. Economists use a model called the Taylor rule to determine where interest rates should be to crush inflation. According to this model, in mid-2022, the Fed funds rate should have actually been hiked to nearly 9%. But Powell stopped at 5.5%. Why? Because of the $36 trillion debt. The average maturity of U.S. debt is about 70 months. That means every single month, hundreds of billions of dollars of old, cheap debt matures and must be refinanced at current market rates. If the entire U.S. debt rolls over at a 5% interest rate, the annual interest expense alone would be $1.8 trillion. That is more than the government collects in total income taxes from every single American worker combined. They cannot raise taxes enough to cover it. They cannot cut spending. If you want to know what happens when a central bank tries to fight inflation while the government borrows too much, Look at the UK in September 2022. Prime Minister Liz Truss announced an aggressive mini-budget with £45 billion in unfunded tax cuts. The bond market panicked. Yields on 30-year UK gilts spiked by 120 basis points in just a few days. Because bond prices move inversely to yields, the value of those government bonds collapsed. This triggered margin calls for UK pension funds, which were heavily leveraged using liability-driven investment, or LDI strategies. They were forced to sell assets, driving prices even lower. A doom loop. To prevent the total collapse of the British pension system, the Bank of England had to abandon its inflation fight and instantly restart QE, buying £65 billion worth of bonds to stabilize the market. Liz Truss resigned after 45 days. The lesson? When the sovereign bond market breaks, central banks will always choose inflation over a systemic default. Now let's look at the ultimate ghost of Christmas future. Japan. Japan's debt to GDP ratio is a staggering 250%, the highest in the developed world, with over $10 trillion in national debt. How has Japan not collapsed? Through a policy called yield curve control. The BOJ literally promised to buy unlimited amounts of government bonds to pin the 10-year yield at 0%. By doing this, the Bank of Japan ended up owning more than 50% of all Japanese government bonds in existence. They essentially nationalized their own debt market. But there is no free lunch in economics. By artificially suppressing interest rates while the rest of the world hiked, the Japanese yen was destroyed. So who actually benefits from this endless money printing? A French banker named Richard Cantillon figured this out in the 18th century. The Cantillon effect states that when new money is created, it benefits those who are closest to the money printer first. By the time the money trickles down to the working class, prices have already gone up. Think about 2023. The Fed was hiking rates at the fastest pace in 40 years. Mortgage rates hit 8%. The average person was struggling to buy groceries. Yet, the S&P 500 rallied 24%, and housing prices stayed near all-time highs. Why? Because the system is flooded with structural liquidity. Inflation is not a bug in the system. It is a feature. It is a highly regressive, invisible tax that transfers wealth from the middle class, who hold their wealth in cash and wages, to the ultra-rich, who hold their wealth in hard assets and equities. As an analyst looking at the data, the conclusion is clear. The U.S. government has no intention of paying back the $36 trillion in real purchasing power terms. The playbook they are using is called financial repression. They used this exact strategy after World War II, when U.S. debt to GDP was 119%. From 1945 to 1980, the government capped interest rates while letting inflation run hotter than those rates. If inflation is at 4%, but the government only pays you 2% on a treasury bond, you are losing 2% of your purchasing power every year. The government uses your negative real yield to silently melt away the value of their debt. They don't default formally. They just pay you back with dollars that buy half as much as they used to. That is the mathematical endgame. So what breaks first? The Federal Reserve is walking a tightrope without a safety net. If they keep rates high, the US dollar index stays strong, crushing emerging markets and bankrupting U.S. regional banks. Just like we saw with Silicon Valley Bank in March 2023, which went under in 48 hours after suffering a $42 billion bank run. But if they cut rates and turn the printers back on to save the banks, they reignite the very inflation they spent years trying to crush. It is a lose-lose scenario. Save the banking system or save the purchasing power. Throughout history, when faced with this choice, central banks always choose to save the system. They will sacrifice the currency. They have to. This is exactly why smart institutional money is flooding into finite assets. Wall Street sees the writing on the wall. They know the printers will have to restart. Look at the traditional safe haven, gold. In 2024, gold hit all-time highs, surging past $2,400 an ounce. Central banks themselves, especially in BRICS nations, bought record amounts of gold in 2023 and 2024. Why are the money printers buying gold? Because they know the fiat math is broken. Then there is the digital alternative, Bitcoin. As the $36 trillion debt mounted, Bitcoin surged past $70,000. Unlike fiat currency, which can be printed to infinity with a few keystrokes, Bitcoin has a mathematically hard-capped supply of 21 million coins. It cannot be debased. The $36 trillion time bomb isn't going to detonate in a sudden, fiery apocalypse tomorrow. There won't be a dramatic single day where the system just completely shuts down. Instead, it detonates slowly, silently, every single day in the real economy. You feel the blast at the grocery store when the price of basic food keeps climbing. You feel it at the gas pump, where filling your car takes a larger percentage of your paycheck. And you feel it most brutally in the housing market, where the dream of homeownership slips further away. The official CPI numbers might tell you that inflation is cooling down to 2 or 3%, but those official metrics often exclude the real cost of living, like housing and energy. The reality is, your wages are playing a losing game of catch-up against the printer. This is the ultimate trap of the fiat debt spiral. The government must continue to print money to service the mountain of old debt. And every new dollar they print dilutes the value of the dollars sitting in your savings account. You are being taxed without legislation. You are paying for the debt without writing a check. It is the perfect invisible crime. So, what is the lesson for the everyday investor navigating this macro environment? Lesson number 1. Fiat currency is fundamentally designed to lose value. Since the creation of the Federal Reserve in 1913, the US dollar has lost over 96% of its purchasing power. Cash is not a safe investment. It is a guaranteed loss in a system built on infinite debt. If you hoard cash, you are the one paying the invisible inflation tax to bail out the system. You must completely rethink what safe actually means in the 21st century. Lesson number 2, scarce assets are your only true defense against a mathematical debt spiral. When the money supply expands by 40% in 2 years, your wealth needs to be parked in assets that cannot be printed. Whether that is real estate, gold, businesses with pricing power, or digital scarcity like Bitcoin. You have to own a piece of the finite world to protect yourself from the infinite printer. The Cantillon effect guarantees that asset holders win, while wage earners lose. Lesson number 3, do not fight the Fed, but do not trust their math either. When Jerome Powell speaks, the markets move. But remember the Taylor rule and the $36 trillion reality. Central banks will prioritize the survival of the sovereign bond market over your cost of living. They will tell you inflation is under control, even as the real cost of your life doubles every decade. You must look at their balance sheet, not their press conferences. The mathematics of a $36 trillion debt spiral leave no room for opinions, only equations. You cannot vote away a math problem. You can only position your portfolio to survive it. So look closely at where your personal net worth is stored today. Are you holding finite, scarce assets that can outpace the relentless hum of the printer? Or are you holding fiat currency, silently paying the invisible tax of financial repression? I want to hear your exact strategy to protect your purchasing power. Comment down below. The macro environment is shifting faster than ever, and official narratives lag behind the data. If you want to stay ahead and understand the exact mechanisms moving global markets, make sure to hit the subscribe button right now. Click the bell icon so you never miss a deep dive into the real numbers. Remember, the best defense against a debt crisis is a profound understanding of the machine. Please note, this video is for informational and educational purposes only and does not constitute financial advice. I am an analyst sharing perspectives, not your fiduciary. All investing carries a significant risk of loss, especially in volatile macroeconomic conditions. Always do your own research and consult a licensed financial advisor before making decisions. Goodbye.